So hello to everyone who's joined us for today's MGAA market briefing. So yes, thank you for joining us. So I'm Alison Cairns from the MGAA. I've just got a little bit of housekeeping to do before we move on to the main event. So polite request first, please can you keep cameras and microphones off to assist us with the minimising any technical issues. And can I also ask, please, politely, if you are going to activate any AI note-taking devices, that you refrain from doing so, as we haven't got the permission of everyone attending. So that's my polite requests done. Also to ask is during the session, please tap away in the chat and pop your questions in there, because we'll cover them at the end. So yes, don't be shy. Get all the questions there, because I'm sure George, who's with us today, will be delighted to answer them at the end of the session. Also to let you know that the session is being recorded, so if you want to review any of the content or pass it on to a colleague, the link will come out to you shortly after shortly after the session, probably early next week, you'll get a link to the session. And last thing to say is that the session is accredited for CPD purposes by the CII. So if it meets your development needs, you can cover it in your training log. So that leaves me to introduce our presenter today, who is George Bucur. I hope I'm pronouncing your surname correctly, from MarshBerry, who's going to cover today's session, which is Specialty Market 2025 Outlook. So I will pass over to you, George.
Alison, thank you very much, and it's a pleasure to be here today. Good afternoon to everyone in the UK. I am calling in from the US at the moment, so good morning from me. Today we're going to talk about what we're seeing in the specialty marketplace, and generally speaking, as we define specialty, that relates to delegated authority firms, whether program managers, MGAs, MGUs, cover holders, etc., plus additional types of wholesale brokers and others within the overall insurance intermediary system. What we have seen over the last 10, 15 years or so is a massive consolidation of clout, and that's happened because there is unlocking of value every step of the way. So what we're going to do as we talk through the market dynamics that we saw in 2024 and look forward to what we're going to see, or we expect to see, for the remainder of 2025, we're going to kind of draw parallels in regards to what we are seeing in the U.S. marketplace, the U.S. market being the largest delegated authority market in the world, and how that impacts that of the UK, Europe, and beyond. Before we get into those details, I want to give a little overview of who MarshBerry is. So MarshBerry formed in 1981 in Cleveland, Ohio. We have 6 offices in the U.S. Our Amsterdam headquarters, or our European headquarters, in Amsterdam, and we recently acquired a firm called IMAS, now referred to as MarshBerry UK, in London. So we have a pretty good spread within those geographies. We have private capital backing ourselves via Atlas Merchant, and have roughly 250, that number's a little low on the deck there, colleagues across those segments that I talked about. Generally speaking, we service that of the insurance intermediary space and of wealth managers. Now, we also handle anything, I would say, tangential to insurance, like TPAs, premium finance companies, risk mitigators, etc. But any service operator in and around the insurance and or wealth management segment is generally where you will find us. And when we look to partner with prospects and clients, we think of our services as kind of 3 pillars: learn, improve, and realize. And why I highlight this is on the learn aspect of things, we are very big into data and analytics. Having a proprietary database that holds roughly $3 billion of agency and broker revenue, we can use that for financial benchmarking, best practices, and allowing our clients to grow and realize their goals and objectives. That leads us to the middle column there where it says improve. Here we have a suite of solutions that offer firms the ability to improve their operations. Now, whether that means growth, profitability, best practices, compensation, best practices as well, those are capabilities that we offer as firms continue on their life cycle. And ultimately, what you're seeing from those first 2 columns is a way for MarshBerry to build relationships with those in the marketplace, so that when they ultimately determine it's time to go through a transaction, whether internal perpetuation, external sale, capital raise of debt or equity, that will be their solution that they turn to. And in doing so, we've created a suite of different products and offerings that we can offer to that of the insurance intermediary space to allow them to, again, reach their goals and objectives. Now, getting into the overall presentation, market clout, it is something that I don't know if people really grasp how perverse of an impact it has within the insurance segment. So today, what we're going to do is we're going to talk about the implications of market clout, why this trend is occurring, how firms are getting to be the sizes that they are, and then the implications across the insurance intermediary space. As we talk through and as we think about the evolution of specialty organizations, we like to say that it is a fight for relevancy. And what we mean by that is that the firms are growing and getting so much mass along the way that independent organizations oftentimes may find it challenging to keep up with the change, whether from a technological, data analytics, employee recruitment, attraction and development, and or other means that allow firms to keep up with those, let's say, very capitalized organizations. And we'll get into what we mean by that in a moment. But this constant thought and theory of evolution is one thing that we are always talking about, and fully acknowledging that when we're talking in premium dollars, the U.S. market is very different than that of the U.K. market. So maybe ignore the numbers that you see in the ranges you see at the bottom of the screen, which are really illustrative anyway to begin with. But the concept is to remain relevant in today's marketplace. You'll need to continue to invest in your organization, get larger, create profitability, and reinvest to keep ahead of the trends that we are seeing. To put into context of where the specialty marketplace has gone in the U.S., we estimate that there's roughly $210 billion of premium placed between that of what the U.S. has as the E&S side or surplus lines market. These are usually policies placed via wholesale brokers, and that of the delegated authority segment, which is a lot of the participation on the call today. But collectively, if you take into consideration the redundancy between the delegated authority space placed in the non-admitted market and the delegated authority policies and premium placed in the admitted markets, we get to an estimated $210 billion of premium for 2024. Why it's relevant and why that context is being provided is that over the years, we have seen the specialty marketplace really explode since 2019. Part of this because of rate, part of this because premiums are flowing into the E&S marketplace, and a lot of it being really perpetuated by the challenges we are seeing on the underwriting side and carriers not able to achieve, or at periods of time not able to achieve, acceptable underwriting results. We saw Lloyd's go through a pretty dramatic, the Decile 10 project or initiative in 2018, or commencing it around that time, and now getting off of that and starting to write more premium. But what we saw in the interim in the U.S. was that premium volume placed in that segment really took off, and we continue to see that make up a significant component of the overall P&C market. As you can see here, the growth rates over the last roughly 8 years have been north of 15%, let's say 10 to 15%, and sometimes getting into the low 30s. So it just speaks to the amount of growth we are seeing from rate and or exposure-based changes. As we look at the overall segment in regards to the size of the largest players, we have an illustrative of where the market is going directionally. And now, while this is respective to the U.S., we see the same dynamics in the U.K. The large are getting larger, and the smaller organizations are getting fewer. That's really the keynote takeaway. And we're going to explain why that's happening as we see a very dynamic and evolving marketplace. Looking at the top 28 firms in the U.S., and I choose top 28 because those are the firms that have $1 billion or more of P&C premium volume. Now just think about that for a little bit. That's a huge amount of dollars. And what's really unique, most of those firms, not all, but I would say the majority, are beyond the borders of the U.S., whether Canada, UK, Europe, etc. And what we are seeing is an expansion of those specialty organizations as they look to continue to grow and to take on market share. Getting back to those 28 organizations, we see that 3 of them have over 25 billion of premium, which is pretty astonishing in itself. 5 are between 5 and 25 billion, and the remainder between 1 and 5 billion. Also, I think it should be highlighted that of those 28 organizations, 24 of them have capital, whether through private or public means. As you'll see, that's going to be a big catalyst in regards to firms getting to be the size, or allowing them to be the size that they are to continue down that relevancy continuum in a very meaningful way. The last note to leave on this slide, of that 210 billion placed in the U.S. in the P&C property, in the U.S. P&C lines, 76% of that premium is placed via these 28 organizations. If you take that back to 15 years ago or so, and it was a very different story, which we'll talk about in a slide later on. Before we do so, let's address why this trend of consolidation is occurring and how it's being made possible. We talked about firms taking on growth, which is the catalyst that allows them to acquire other organizations, reinvest in their company, whether technology, distribution, et cetera, data analysis. But it's also allowing them to attract top-level talent and colleagues. And we've seen a lot of this, both in the UK and US market, in regards to either brokers and or underwriting talent being taken from competing organizations and or from the underwriters, from the carriers, and brought into the insurance intermediary space. And there's reasons why that's happening, again, which we'll go into more detail in a second. But what they're doing with those relationships and with those capabilities is they're developing centers of excellence. It is regularly happening in the marketplace where we have firms come up to us and say, do I go broader or do I go deeper into the risks that I currently participate in? And almost all the time, the response is, you want to go deeper, because with that depth, you have more differentiation. You know how to extract value to that of your carrier partners, as well as that of your distribution and or insureds. And all that together allows a firm to be more differentiated and control more of where they are ultimately going. So those niches help to a firm to really define themselves in a meaningful way to that of their partners. Firms are effectively starting to utilize technology. Now, this is a very, very slow burn, I will admit. And while the insurtech boom and bust that happened several years ago would have maybe tried to convince others that the market was going to change dramatically overnight, that is very far from the truth. But we do see applications of technology, whether through data analytics, through AI, et cetera, that is applied on a very bespoke nature. And with that, it's allowing firms to extract profit and or from a marketing perspective to reach firms that they otherwise wouldn't have been able to do. And then finally, or not finally, but next, the firm's leveraging what we call a four-legged stool, meaning having delegated authority capabilities, general binding, and whatever doesn't fit into those two buckets is placed through their open market brokerage or wholesale brokerage, and then finally providing captive management services. The last point here comes to negotiation clout that these large brokers have. And as an illustrative, in the U.S., we have seen commercial premiums or commercial commissions go up by around, I think it's about 200 basis points, while we've seen personal lines commissions go down by 150 basis points over the last 2 decades. This all in all relates to 350-point basis spread in regards to where we see the commercial lines going to that of the personal line segment. And as such, most of the broker community is more focused, or at least paying higher valuations, on that of commercial lines types of brokers and agents. Also, what we have seen are the margin expansion of the public brokers have really, in a meaningful way, have done just that and expanded. In the 2020-2021 period, we saw COVID, so people started traveling less. That allowed the travel and entertainment expenses to essentially go away, which allowed margins to go up in a meaningful way during those years. Subsequent to that, or kind of tangential to that, I should say, a lot of these large brokers started investing more heavily into their specialty arms. Delegated authority firms can run at margins that are well in excess of that of the retail brokers. And because of the growth that we've seen, as I mentioned previously, in the delegated authority and the E&S marketplace, we have seen these specialty components become more and more significant to the overall public brokerage. And as such, we are seeing the margins move to levels that we have not seen historically. Now, when you think of the overall segment, this is a little different in different geographies, but in the U.S., it is commonplace for that of a retail broker and a specialty platform to be under the same umbrella. Of the top 20 retail brokers that existed via the 2023 rank of Business Insurance, which is a publication here in the U.S. that lists out the top 100 firms. We just took the top 20 for these purposes. 15 of those organizations have specialty platforms, and all of those organizations have acquired a specialty firm, whether delegated authority or wholesale broker. Part of the reasons being is that by firms creating these platforms, they are unlocking value. One, they're bringing more larger premium volumes to that of their carrier partners and providing access to capacity that they otherwise may not have had. They're streamlining their wholesale relationships to that of either a panel of a few select large wholesale brokers and or bringing wholesale broker capabilities in-house, which allows them to keep more of that commission pie, if you will. They're offering unique products and value-add services to that of their distributors. Again, these firms are usually the largest that exist in the world, and so they have the ability to invest in technology, actuarial data analytics, et cetera, that allows them to differentiate compared to that of their competitors. And they're having cross-sell capabilities where if a retail distribution platform has a concentration in construction, for example, they might be able to partner with that of an MGA who has a construction focus, create cross-sell capabilities, either via product development, proprietary products, and or unique solutions that they didn't have prior. And then as we talked about, the higher commissions that we are seeing, broadly speaking. Now, when we talk about market clout and what we are seeing at a global scale, what we are seeing is the biggest firms are getting larger in a significant way. I alluded to this earlier in the presentation, but just looking back 15 years, the 10 largest specialty firms that existed in 2024, looking back to 2009, the 15-year period, those firms, most of them didn't exist for one, but the ones that did exist comprised around 19% of the specialty marketplace, or of the $44 billion specialty marketplace. Today, we see the top 10 organizations bringing up $133 billion of premium. That's of the $210 billion we talked about previously. So essentially creating 2/3 of the premium placed in the market, in the U.S. market, I should say. And we see overall growth of those firms of a CAGR of north of 20%. That's 20% per year for each of the 15 years. But that is probably significantly understated because most of these firms were not really even created until later in their in this time cycle. So, for example, Ryan Specialty Group, created in 2010, really got started in 2011. So their CAGR would enhance the CAGR that we're seeing. Point of the story, though, is these firms are growing and growing very quickly and consistently. Outside of inorganic means, we see what we call incubators, or firms that are bringing in underwriting talent or brokers, giving them a back office and allowing them to grow and develop their book of business. And then we have the organic tailwinds that we talked about. Focusing in on the incubator side of things, it is commonplace now where firms have incubators, and this is both in the U.S. and the U.K. And what we are seeing is the incubator has a back office. They'll sponsor an underwriter or a group of underwriters to come over, give them back office administrative capabilities, and allow them to do their thing. Usually it's about a 3-year process to break even, 7 to 10 to 12 years to see maximization of the value. But I think Beat, for example, is a great example with a firm that had presence in, or still does have a presence in the UK, but recently transacted at north of $300 million of premium with essentially that type of a model. There are many others, and this is just a sample of the firms that we see this happening at, but it is commonplace now, and one of the main growth means that we are seeing. Primary reasons are, from a buyer's perspective, it's cheaper to provide this back office service and allow firms to incubate these underwriters and books of business than it is to go out and maybe make an acquisition, which can be tens of millions of pounds, et cetera, and probably has more risk, especially when you think about it from a cultural, from a rich and a niche and a differentiation expertise. By incubating, you can specifically target risks that you want to focus on to allow you to diversify an organization where in delegated authority, it's very common to have concentrations, whether it's a line of business, whether it's a specific industry, a single coverage with a market, et cetera. From an underwriter perspective and a broker perspective, these incubators are attractive because it allows them to maybe tap into value that they may not be receiving in their current employment structure. It allows them to unlock their entrepreneurial spirit and really build something that many can value from. As we talked about previously, a lot of the underwriters are coming from the risk providers in the marketplace, the carriers, and by going and setting up shop independently, part of what we are seeing is that they're able to unlock value versus in a carrier organization where carriers are valued more significantly lower than that of insurance brokers, at least what we've seen from a development perspective over the last several years. Insurance brokers and distributors valuations are going up while carrier valuations are going down. As we've seen over the last several years from an organic perspective, the premium volume has just grown. We talked about this previously to the point now where specialty premiums comprise over 21% or expected to comprise over 21% of the premium placed in the P&C marketplace in 2025 in the U.S. So that is a significant tailwind, and we've seen rates really in an unprecedented clip increasing over the last several years. Now the rate of increase is coming down. However, we still see rates that are above zero, so that means you get premium growth, and as such, the distribution community generally benefits from that. Looking at it from an M&A perspective, we have seen a very robust appetite for specialty organizations, and that continues despite what you might see in 2024 when we had a trend of around 180 deals completed in 2021 through 2023 for each of those respective years. 2024 saw a decrease due to a lack of quality sellers, and we're seeing these same implications in the UK. Now, in the US, there's more of a regeneration factor where firms tend to sell and then maybe underwriters split off and or owners wait out their non-competes and they get back into the business. In the UK, we don't see that regeneration factor as much. However, the same trend is true in that we are seeing fewer and fewer specialty firms transact because, frankly, it's a lack of supply. There's plenty of demands, plenty of capital and capacity that wants to be put to work. They just can't find the right firms or really the quantity of firms that they're looking for. To put this into more context, what you're looking at is the percentage of, on the top column section there, the percentage of specialty firms that has transacted for each of the respective years. And you see it starting in 2018 at 4%, going up to 7.1% in 2024. But if you look at the trend, the consolidation of 9%, 9.2%, 10.1% in 2021 through 2023, that's a meaningful component of the overall segment. And if you compare this to that of the retail firms, you see that specialty firms absolutely have a preference from an acquisition appetite perspective. And again, it's because of the differentiation, the higher growth they tend to have, and the overall capabilities and expertise that they bring to the table for that of the consolidators in the marketplace. When it gets to valuations, we have seen valuations that have really been on the rise for 15 plus years. On the screen right now is an excerpt of what we're seeing with the public brokers. And you can see the historically high EBITDA multiple we have seen for public brokers really cresting in 2000, not cresting, I should say, still going up potentially, but hitting a high in March 31, 2025, being valued at 21.7 times EBITDA. Getting specific to independent organizations, and this is based off of the 71 transactions that MarshBerry has completed of specialty organizations from the 2020 through 2024 year, broken out by respective years. We see that the median transaction in 2024 was 16.2 times all in. Now, when I say all in, this means an upfront payment plus earnout potential. And you can see that all-in valuation really soared since 2020, up 35%. More notable, however, if you look to the right side in the orange bubbles, you can see the all-in valuation went from 13.1 times in 2020 to north of 21 times in 2024, a 60% increase. What you're seeing here is that the buyer community is putting a high preference to those platforms. And what do we mean by platforms? Those are the largest organizations, diversified from a concentration perspective, solid underwriting results, have access to data and analytics, and really can be a foundation for an organization to go off and make other acquisitions, hence the concept of a platform. But the valuations have really been another catalyst for why incubators have taken off over the years, because frankly, it's a lot cheaper for these organizations to set up incubators than it is to go out and make those acquisitions at the multiples that we are seeing. Now, I do want to clarify, the multiples in the U.S. are probably 1 to 2 turns higher than that of what we are experiencing in the U.K., but still, by historical terms, towards the top of the valuation spectrum that we have seen. Now, let's look to those that are maybe tangential to that of those largest organizations in the insurance distribution segment. And specifically want to focus on the fronting and hybrid markets. Well, this has been a trend that has developed for last probably 6 or 7 years in the U.S. and last couple of years in the U.K. and now is getting into Europe. It has been a big catalyst for what we have experienced, and we're going to talk about that. We're also going to talk about the challenges to carriers. We've alluded to some of the underwriting talent that might be coming into the service segment of the insurance distribution segment, and that will be an area we're going to highlight. And then we'll focus on the challenges for independent firms and delegated authority platforms taking risks, those implications, as well as regulatory. As we look at the fronting marketplace, you can see it's been pretty consistent in regards to how the fronting marketplace has supported the delegated authority segment. Now, to be very clear, as we talk about the non-affiliated in the U.S., we have certain MGAs that are owned by carriers, and then we have MGAs that are not owned by carriers. Those non-owned carrier MGAs we refer to, actually I'd say AM Best refers to as non-affiliated. And as such, you can see that for those non-affiliated premiums, roughly more than a third of them are placed via the fronting markets. Now, the implications here being is that private equity got into the fronting marketplace expecting to be investing into more service-level organizations. What has happened over time is that the primary carriers and the reinsurers have put more pressure on these fronts to take on more risk, and now that name front has somewhat morphed to hybrid, as these are hybrid type of primary carriers that are taking more risk than they initially may have intended. That's putting pressure on their overall operating because more capital is having to be deployed, and as more capital is deployed, it brings down the overall returns of that of their private equity sponsors, which sponsor the vast majority of the fronts that are out there. So this is a dynamic that we are watching that may have implications on the delegated authority space in the months and years to come. We talked about the challenges for carriers, but to really sum it up, I want to dive into what we've seen again over the last 15 years in regards to the largest carriers' market share. So what we're doing on the top, I know there's a lot going on here, so I'll walk you through this. But in the top, we have the top segment. We have the top 10 specialty firms. This is the same screenshot or the same data that we saw on a previous slide. Some things to note, however, is the market share of the top 10 firms went from 19% in 2009 to 63% in 2024, a 44% increase, essentially tripling their market share. If you look at that of the commercial components of their carrier partners, the largest carriers made up 42% of the commercial line. So it's not really apples to apples. The top's looking at specialty premium. The bottom is looking at the commercial lines premium. But the top 10 carriers made up roughly 42% of the commercial lines premium in 2009. Fast forwarding to 2024, not the same, but the top 10 carriers in 2024 made up 36% of the market share, losing 6 points of market share. So you can see where the insurance distribution segment is expanding and gaining market share, mainly via acquisition, versus that of the carriers who are generally losing market share because, frankly, capital has not been that interested in investing into the carriers because of the regulatory and capital constraints that come along with it. Some other points to note: only the smallest carrier in 2009, which was Progressive from a commercial lines perspective, had premium volume, and I'm just getting a note here, had premium volume that was less than that of the largest brokers. However, fast forward in 2024, you see that the top three, really the top two brokers are larger than the largest carriers, and the top three brokers are rivaling that of the largest. So a very big difference in what we are seeing and how we are experiencing the overall consolidation of the service segment compared to that of the regulated risk-taking segment. Further, as a result of this, we talked previously, although I started my words a little bit, we talked previously around how the carrier valuations have generally declined over the last 8 years versus that of the insurance broker segment, where we've seen the public brokers, which is that lime green color on top, go up 80% over that same period of time. And we've seen that of the general U.S. insurance brokers, privately held, increase by about 50%. So you can see where the capital and where the preference is from a demand perspective, which is driving valuation. Now, when we talk about independent firms, there are consolidation pressures without a doubt. If you're an MGA or a wholesale broker, you distribute through retail brokers. Those retail brokers continue to get consolidated. The peers of the specialty firms, whether delegated authority or wholesale, are being consolidated and given more resources, whether capital for acquisitions, technology access, data analytics, et cetera. And that's creating a bit of pressure whenever we see consolidation. In the market, there is a continued need for differentiation. And by doing that, you need to continue to invest in data, in your people. And oftentimes, independents may find it challenging to either attract, retain, or develop that of key individuals, as the larger platforms have more resources, development capabilities, and frankly, whether it's markets or distribution access, than that of the independent operator. Generally speaking, there are always exceptions, obviously. And then when it comes to strategic positioning, being a one-stop shop for that of an insured or retail broker is where it gets to be a little more challenging for that of the independents, as by going deep, as by creating those the differentiators, they can't always be a one-stop shop where the retail broker and or insured can get the access to all the products that they are seeking. And then finally, when it gets to the overall technology and investments that we've talked about, it is just frankly mind-blowing to me how every specialty organization has their own in-house technology, or they have technology that is just very rough and they putting a square peg into a round hole, essentially. We are seeing technology take root, and what we will expect is over the years and the, let's say, decade to come, technology is going to become more and more meaningful, whether, again, from the data capture and analytics from an underwriting perspective, whether from a marketing and outreach perspective, and or from an efficiency on the policy administration side or claims administration side. Those are just a few examples. There are others. Next, we are getting to the point where the largest delegated authority platforms are now taking risk via sidecars, quota share, et cetera. You have an example of those up on the screen. Talk about a really different dynamic than what we experienced just like 2 or 3 years ago, where private equity wouldn't want to touch this. What private equity is doing now is, because these delegated authority platforms are so diversified across, let's say, 15, 20, 30 different programs, they have a long history of results. They're now starting to take risks, setting those up in sidecars outside of that of the equity structure of the specialty service organizations, and beginning to reap some of the rewards from quality underwriting. It's a vote of confidence to that of the reinsurance brokers or the reinsurance community, obviously, but also another way to juice cash flows as they look to continue deploying capital. Now, I always caution independent organizations when they think about taking risk along the lines, the largest firms can do it, they're diversified, they have massive amount of capital capabilities and resources. Independent organizations really need to think twice before taking risk, and the implications, as we've seen many organizations get themselves into trouble by taking risk, especially in the casualty lines. It could be probably a little more justified in the short tail property lines, but something to think about. And we can't have an insurance conversation without talking about and at least contemplating the implications of regulation. The biggest one being the DUAE assessment that AM Best rolled out several years ago. Really nothing has come of it of substance. However, as delegated authority becomes more and more relevant on a global scale, you have to imagine that AM Best and others are going to continue to look at delegated authority, the implications to that of the carriers and that of the ultimate insureds who they are trying to protect. So nothing really of an update other than to reflect on what we've heard and seen over last year, but no real movement there. So as we get to the key takeaways, we are seeing the largest firms getting larger. The top 28 organizations in the U.S. and probably there's 30 firms from a global perspective with over $1 billion premium make up roughly 75% of the specialty premium that is placed. Firms are growing via organic means, setting up incubators, and inorganic or acquisition means, and they're doing so by taking on private capital. As a result of the largest firms getting to be the size they are, it's creating market pressures for many in the ecosystem, from that of carriers to other service providers and independent organizations, and we continue to monitor that and assess how things go. But at the end of the day, the message is clear, is that delegated authority today is the belle of the ball. And as such, they are highly sought after because they are able to generate superior returns, generate higher margins, higher growth rates, and really provide a differentiated offering to that of the insurance segment. As we look forward, what do we expect? We expect that there will be continued robust acquisition appetite, although there still could be a lack of quality sellers in the marketplace. We're seeing a new wave of buyers, and these buyers are unique because unlike the predecessors that emerged 5 to 7 years ago, these buyers are getting out and they're moving quickly to that of the UK, Canada, and other geographies as they want to get ahead of the curve that we are seeing. And as a result of the overall interest and appetite, we expect valuations to remain robust. Now, the trends that we're following comes down to tariffs and other inflationary pressures, the implications on the interest rate environment as a result of those inflationary pressures, looking at the pricing environment of insurance policies and risks. Again, in the U.S., we've seen an elongated firm-to-hard rate market cycle that's really unprecedented. It's a little different in the UK where it's a little bit softer or softening from that regard, but still something that can drive a lot of value just by sitting around and growing premium rate. So we were watching that. And then we will continue to watch, see how the flow of premium continues between the E&S and delegated authority markets. And then finally, we're watching the capital events at the largest players. Many organizations, both in the UK and the US and beyond, have had challenges in recapitalizing and or finding that next layer of liquidity for that of their shareholders. That has significant implications on the overall marketplace. Now, it hasn't trickled down to independent operators just yet, but it is one thing that we continue to watch. So with that, I will pause and see if there are any questions. I think I saw something pop up in the chat. And that was Allison asking for any questions. So Allison, I will...
yes, it was me asking for questions, and yep. We don't have any at the moment, but hopefully there may be some in a minute. I mean, what I can allow people a little bit of typing time. I will, when I send out a link to the recording, there will be a request for feedback. So my request is, one, if there's any questions, we've still got time, and two, yes, please do share feedback with us afterwards.
Excellent. Well, thank you to the MGA Association. Assuming no questions pop up here, but appreciate getting on again this year and providing the update, and we'll look to continue to do so if you'll have me. So thank you.
And yes, thank you very much for sharing the update with us and for your time, especially as it is first thing in the morning where you are. You haven't got the luxury of it being lunchtime.
Not yet. So, all right. Thank you very much, Allison. Take care.
So yes, thank you everyone for attending. Thank you.